Golden Rule Radio is brought to you by McIlvaney ICA. ICA has been helping people take delivery of precious metals and find storage options for decades. They have also helped thousands of investors with their precious metals IRAs. Call ICA today for your free portfolio review at 1-800-525-9556. Or download your free report by clicking the link in the video description to learn how you can double your gold and silver ounces even within an IRA.
Welcome back to this week's Golden Rule Radio, and appreciate the opportunity to have you guys return this week and listen. We've got a special guest today. Rob has been on the show before, not to be confused with Robert, the stalwart and Dollar King. But Rob, we're going to be excited to have your insight today here, particularly in regards to some premium histories as well as the platinum discussion that certainly is timely. So before we get into that, Miles, would you like to kick off the week with gold?
Yeah, I think gold would be a pretty good place to start this week because gold is putting in a double bottom, coming down to the November 30th lows, which we've been talking about was expected. I know kind of a running story we've been telling is that you don't argue bull market until you have some confirmation. And while gold has been bouncing up and down between the mid 1700 and as high as maybe low to mid 1900 range, it's a pretty big swing range that we've been in since November. So gold is back down here. Today is going to be, let's call it a breakout day one way or the other, although the only way it could break out is down. So from a bullish standpoint, I would certainly like to see gold hold the line here at around 1765 and turn up. But history tells us, at least recently, that we may see it put in slightly lower prices. Now, that doesn't concern me at all because we're still at the most shallow potential correction zone, going back to the start of the bull market in 2016, and then ultimately when we confirmed in March of 2020, and we had this big run-up starting at around 1450 all the way up to 2100. So gold still looks and continues to look extraordinarily bullish, even if we do continue a little bit of downward momentum for the time being.
So not to put you in a corner, but that 1765, you'd say from where we are right now is a likely next support level that could certainly hold and create a bounce. And you put up a chart 2 weeks ago that showed that declining formation there, as you call compression, and it's lining up with that Fibonacci retracement level of that 1765 range or so too. So do you think that we've got a really good chance there of bouncing, or do you feel like there's a setup there for that to be a soft support?
Sure. Well, the argument would be soft support with probably a continuation down. And the reason for that is after we put in that Fibonacci retracement, 1763, back on November 30th, we did recover a fair bit. We got all the way up to about 1950, 1960 on January 5th, but that was
$200.
Yeah, but that was short of the previous high. So we put in a lower low, and then we failed to put in a higher high. So from a charting perspective, a price action perspective, you would assume that that means you're going to see continued movement down until you're proven wrong.
All right, well, may it prove it wrong. So without further ado, let's transition a little bit to platinum, the next exciting metal this week in terms of its strength and volatility. And Rob, do you want to kick us off with your thoughts and recap over the last couple of weeks on that white metal?
Well, platinum has been exciting. I know Miles is going to have some great information coming up. All I wanted to point out was we have been focusing on platinum now for going on 3 years as an option, and now it's starting to pay off. Miles, why don't you fill us in with some of the numbers, especially from this past spring?
Sure. Well, I made a pretty bold statement last week, right? I said I think you can almost confirm that platinum is now in a bull market, or at least starting to push that direction. Now, I think I went ahead out last week and said confirm, so I'm going to stick with it. Yeah. I'm going to stick to my guns.
I'm going to make you stick with it, too.
And, if you and I could make the market do what we wanted to, right?
That's right.
So, yep. But we are looking at platinum at the highest pricing, or at least last week hitting the highest price since about September of 2014. We're seeing a little bit of a pullback this week, but that's expected given the monumental rise that platinum put in. We're talking going from 1,080 up to over 1,300, maybe 1,330 in just a matter of a few days, a few hours. And seeing that turnaround wouldn't be a surprise. So the real question in platinum is, where's it going to find footing? Like I said, you put in these higher highs. Now the old high needs to become the new low. So as it's climbing the stairs, where does it put its foot down? Maybe 1165, maybe all the way down at like 1050, but somewhere in here, not too far down, especially when you think back in March, platinum was under $600. So to go from 600 to 1,300 in less than a year is pretty substantial. For it to come off a couple $100 is nothing in the grand scheme of things. And Rob, one of the reasons we wanted Rob to join us again this week, being kind of our platinum guru and some of the alternative metals, and then following some of the history on this, having quite a bit of history in the precious metals industry, is other than from a charting perspective and what we want to see the platinum price doing, Rob's brought in today a number of data points that harkens back to the last conversation we had with him a few months ago, discussing catalytic converter production and transitioning back away from palladium, which the automotive industry went to about 10, 12 years ago, and starting to push more towards platinum again, which is going to increase not just the dollar price of platinum, but the demand of platinum going forward from an industrial standpoint. So other than me and my charts, Rob, what are some other reasons we can hang our hat on the platinum industry today?
Well, about 9 months ago, BASF came out with a report stating that platinum could be substituted for palladium at a very modest level and not change any of the environmental impact, which was a real sticking point for the automakers. They were like, look, we could convert back to platinum, but it would take 2 years of regulatory compliance and oversight for us to make the switch back to platinum. I always thought that was a strange argument when we're talking about substantial difference in price. Platinum used to be $1,500 to $2,000. Palladium was in the $300 to $400 range, sometimes $250 range. And for them to argue, hey, we can't do anything until we get EPA sign off on this sounded a little silly to me. But BASF, like I said, more than half a year ago, came out with a report saying, no, you can begin to change over slightly to platinum without having to go through regulatory oversight. It doesn't change any of the exhaust parameters. I'm not an engineer, but you know what I'm saying. And Johnson Matthey actually acknowledged that they had begun doing that already. So I think their number was about 5% of the palladium was switching over to platinum, which was a change in demand of about 15,000 ounces going to platinum. So even though only small amounts of palladium and platinum are used in catalytic converters, it adds up to be quite a bit. In fact, in major urban areas now, there is a growing theft where people are crawling under the cars with handheld electric saws and cutting off the catalytic converters and running away. So it's a little cottage industry of theft in that regard. We are seeing that affecting, I believe, the price fundamentally more so than chart analytics.
Well, and that sounds like a lot less effort than ripping all the copper piping out of an old house.
And it's true, too, because it actually happened to my son. So, true story.
Oh,
yeah,
wow.
It really did. He thought a loud Harley Davidson was driving by when he started his car. It was his car. Anyway, that's okay. You guys are talking a lot about the industrial demand, and that's really where the pressures on platinum lie. And not so necessarily with gold. So we've started with gold, we've moved to platinum, and that brings up a really critically important relationship that a lot of listeners may not realize we follow, and that's the gold to platinum ratio as well. And it's been one of the largest drops in that ratio on record here in the last 11 months. And really what that foments and what that's telling us is that historically that has precluded an equities market negative return or drop in the equities markets, where you see platinum or a general broad-based commodity rally leading higher when gold is dropping like it is right now. and it bodes poorly for the equities markets. And the opposite is true as well, which has obviously been what's played out. So that's sort of pointing, this platinum rally with this gold drop is pointing to negative economic signs, negative equities signs in some theories, but also to the inflationary aspect. We've talked a lot about platinum and silver, the white metals, having a lot of catching up to do to gold. And that's because they now are starting to price in. It's been this very deflationary, relatively stronger dollar environment over the last number of years. And now you're starting to see that turn. It'll be fun to watch as we've gone from over 3-to-1 on the Dow to platinum ratio. We're now below 2-to-1, coming up close to like the point you were talking about, Rob, nearing a 1-to-1 price difference. That's a big, big swing.
Well, and I'm glad you bring up the commodity to equity concept too, because I think especially nowadays, a lot of people seem to forget that we're talking about actual companies who have to produce actual revenue. This isn't just college kids playing with GameStop stock with their college money. You know, these are actual companies who have budgets and have to work within those budgets and have stock prices that reflect their revenue, or at least technically is supposed to. I know that's not how the stock market has worked for a few decades, but that is technically how it's supposed to work. So when you look at something like these industrial metals, rhodium, platinum, iridium, palladium at 600 a couple months ago, you know, when you're looking at all these prices increasing, that's cost of production going up for auto manufacturers and housing developers and all sorts of industries that rely on timber and ore to keep their businesses afloat. So, and I think that's why you may be seeing a stall in some of the stock market. And we've been talking about this Dow stall. Even though it's putting in new highs, it's not really doing it with any gusto, while these commodity prices are starting to go up.
Yeah, and I don't think we've seen anything yet. I think that we're going to see some strong prices, not just in the metals, obviously, from an industrial standpoint, but broad-based commodities, like you just said, Miles. Number one asset in 2020 was timber, and another indicator that things are going the wrong direction with prices. But before we leave gold, eventually we'll get to silver. But Rob, what else are you seeing in the gold market in general, whether it be coins, premiums, availability? You're in your 35th year here with us. How is this market a little unique, and in some ways, how is it repeating itself?
Well, when I started in the mid-'80s, gold had only been legal for maybe 10, 11 years at that point. And the clients who were calling us were very focused on what happens if the government were to confiscate gold again. And then that kind of faded. As time went by, people's memories were not really focused on that, and I understand why. But they do like the privacy. I'm getting more and more calls from people concerned about government seizure of assets, particularly gold. What I saw back in mid-'80s to late 90s is we were primarily dealing in mid-grade American collectibles. But in 98, we switched our emphasis from uncirculated American coins to uncirculated European coins. Still the same age, pre-1933, because the premiums were radically different. The chart that you see is the ratio going back to 1998 of $10 Indian gold coin, half-ounce gold piece, versus a half-ounce gold American Eagle. In the late 90s, it took 5 half-ounce gold Eagles to equal one MS-63 $10 Indian. And that's referring to the grade. And that ratio stayed, 3-to-1, 5-to-1, almost 6-to-1 up until about 2009, 2008. And then that ratio began to drop. From 2008 to spring, say February 2018, we noticed a historic loss of premium in the American collectible market versus the bullion. And Tori, you'll recall, our company shifted emphasis back to uncirculated U.S. $10 and $20 gold pieces in February 2018. And that, as the chart indicates, has been a great opportunity for our clients, just like the ratio of platinum to gold and silver to gold. There's a ratio between the collectible coin market and gold bullion coins. One of the things that I am seeing now is where all the buying is happening, where most of the customers now are preferring the collectible coin market, because there's privacy there and there's some protection from government seizure there as well. So we see a great opportunity. And as those ratios expand like they were 10, 15 years ago, the opportunity exists to go back into more bullion type coins or European type coins. And we've never lost emphasis on the European coins. We continue to enjoy them. I mean, you're only talking premiums of 3 to 5% more than a comparable bullion coin in size. So that's a no-brainer. But the real opportunity investment-wise I see happening in the little bit better graded US $10 and $20 gold pieces.
So when we talk on this show, we do talk a lot about ratio trading.
Yeah.
We had a call to action on two different things last week regarding platinum and silver for our clients. And what you're talking about is a completely different ratio and what we also call premium swapping. So instead of a ratio trade, it's a premium swap, where another way of compounding ounces is by going in a hot market, high premium market. We're going to sell against that market. So any clients that own that particular product will be getting out while the rest of the industry is getting in.
Exactly right. I mean, if you go back to our emphasis in the European coin market back 20 to 22 years ago, even 18, 19 years ago, it got to a point where we totally ignored the American market. And then come February 2018, we were exchanging the European coins that our clients had bought 15, 20 years earlier for better graded American collectible coins. And we had clients gaining anywhere from 50 to 100%, and sometimes even higher than that, more American coins than they would have been able to have bought 10, 15 years earlier. In some cases, I had clients gain as much as 150%. So there is an opportunity in that market. We are constantly looking for opportunities.
Yeah, that's exactly right. It's not just sitting in the corner of the closet collecting dust. And that's what we're doing with silver and gold as well, right? Whether it's in a storage account or an IRA or in your safe at home or in a safe deposit box, doesn't matter. Anybody can take advantage of those opportunities. And so transitioning over here to silver, Miles, why don't you show us what's transpired and strength that silver's showing right now?
Sure, and I think a discussion about the premium play is actually the perfect transition for silver, because I know we've been talking about what's been going on with, say, Silver American Eagles, which is just a bullion coin, but as the most popular coin out there, has been running across the board nationwide at pretty staggering premiums for just a bullion coin. And also point out something that we haven't talked about as a product, and that's Old Peace and Morgan silver dollars, which are also running at pretty substantial premiums right now. There's no perfect catch-all answer to the ratio trading. You know, there's not a one-size-fits-all, this happens at this time to this product always. And I think that's why it's important to work with advisors like we try to be at McIlvaney ICA, where we're constantly watching the differences of these different products, like say an MS63 $10 Indian or a circulated grade Peace dollar. And as those premiums individually float up and down, looking for the opportunities there. So I'm glad we got to talk not just about the gold-silver ratio today, but gold to platinum, which I'll throw a chart up here quick as we're transitioning over to silver. And you can see how platinum is starting to make pretty substantial gains against gold while still having a ways to go, up about 75-80% against gold from where it bottomed last March. And then, of course, the gold to silver ratio, which has gone from 120 and is now bouncing around in the 60s. That is a good transition over to silver, which peaked back in August of 2020. And then we did put in that retest here back the first day of February. So they're up around $30, and silver just keeps climbing. So while we're seeing gold compressing down, it is very likely because of how weak this double top was in silver. The fact that it double topped and it barely dropped at all down to around 26 and change and is starting to climb again, it's very likely silver, like platinum, may follow suit and break out and start its next leg of the bull market. Now, if that's the case, with gold lagging here, and with my expectation of seeing gold sit sideways or even continue down, we're really going to see some of those ratio trades compress. And that's why we have been pushing the last couple of weeks the importance of taking time to discuss your personal portfolio with an ICA advisor, because there are going to be opportunities, whether it's an MS-63 Indian, whether it's a circulated grade peace dollar from the 1930s, whether it's silver American Eagles, whether it's British sovereigns. All of these products have their variable ratios against other products. And anytime we can find an opportunity to stay within metals and increase an ounce position, we absolutely want to pursue that.
Yeah, the gold-silver ratio has actually come down 3 points. And you see it reflected in the charts that you're putting up here with that gold drop and the inverse action or the flat action of silver. Just in this week alone, it's declined from 68 down to 65. And so that's what you're saying could potentially continue to progress, is a decline in that gold-to-silver ratio. And so we have eyes on that. And again, it's everybody in a little bit different situation based on your entry point. But I love the discussion on the premium and the silver American Eagles. Yes, we can get them all day long. It's just the market is hot. And like Rob is alluding to, there's times that it's a buyer's market and there's times that it's a seller's market.
Absolutely. I had a client back in the spring, and we traded him for 10,000 Silver Eagles that he had in his IRA, and we gave him 11,000 ounces of 1,000-ounce bar silver. So he got a free 1,000-ounce bar of silver just because the premium on the Silver Eagles had reached a ridiculous point. We just took a third of those 1,000-ounce bars that he bought back in the spring and converted it back to gold at a 56% gain in gold ounces. Now, you think ratio trading is happening a lot. It's like watching the grass grow. The bumpers rust, it's very boring, but when the opportunities happen, you have to have people in position on your team that can point these things out, because my client would have never have known the opportunity to gain a free 1,000-ounce bar of silver or even to gain 56% ounces of gold without people pointing it out to him.
No, amazingly, that's exactly the case now. It could be a seller's market for a silver American Eagle in the middle of a buyer's market for silver.
Right.
So you can stay within the same color of metal, and yet at the same time, we've got a buyer's market in the premiums on these U.S. collectible coins or semi-numismatics. And so it's fun. Every day is different. And
every day's different.
Well, and it's also important to remember that it's not the U.S. dollar value that is dictating when to do these transitions, right? Doesn't matter if silver's $5 or $500, or if silver's on the way up or on the way down, or if we've ended the bull market or begun the bear market. None of that matters when you're looking at the relative pricing.
And the beautiful thing about the McAlvany Group is that we've got a team of people. There's no way I can be on top of all these different things. And so I really love the combined effort of different people showing different things, because we're constantly talking about this amongst ourselves. Where's an opportunity? And somebody will point something out, and then we'll all take a look at it. So it's really great to have been part of a company like this for this long with as much talent.
Rob, I echo those sentiments, and it's amazing where we are. But I want to pick up on something Miles just said, and that's dollar strength, because we've actually seen a little bit of dollar strength, at least in terms of the U.S. dollar index here. So
the last few days.
Miles, if we can talk about that briefly, because I think that also helps describe a little bit with what's going on in gold.
Well, certainly in Robert's absence this week, I'll do my best. We're looking at a dollar rally that Robert's been discussing for a while now. So I don't know if we can say anything shocking has occurred. We dated back this declining trend line back when the dollar peaked between 2016 and 2017, which we've tunneled through the market as the dollar has risen and then ultimately fallen since it started to fall last spring. The dollar is having a rebound. We are getting a fair number of questions, or I certainly have been. Why are we seeing the dollar stronger? Why are we seeing gold down given the rampant and increased amount of spending that we're seeing coming out of the new administration in Washington? And my argument to that is because that's not the only thing that dictates the value of the currency. You're looking at the dollar just like everything else is ratios we talk about. The dollar is also a ratio compared to other currencies around the world. And I think it's important to remember that.
Really important.
Very important. So the dollar is corrected back up after coming into this lower low it put in back in January of 2018, all the way down at around 88. And then we bounced and failed to put in a higher high, and we've started to come back down from there. It's not unreasonable. We've seen a bounce off of those levels around 88 and 90. This is sort of a double bottom type thing we were just talking about with gold. Most likely, you're going to see the dollar either have completed its bounce already, which has been relatively shallow comparatively. The last time we bounced goes back to August of last year, and a very similar type of move, and then it continued back down by November, putting in even lower lows. So I would argue, even if the dollar manages to push a little bit higher, my money's still on further decline with the dollar coming down to maybe the 84, 85 range next, but ultimately we're going to see sub 80.
I totally agree. And I'm encouraged by the fact that our listeners are really paying attention, and our clients are. I get called and they're asking, hey, explain to me again. I don't understand how we can have such weak dollar policies, monetary policy coming out of Washington, the Treasury, the Fed. How is it not the fact that the dollar is just collapsing already? They're really predicting and concerned about a dollar collapse. It's the relative price to other currencies. Unfortunately, this is a global fiat currency game that we're seeing, and all currencies are being debased across the board. And the dollar index is a relative strength, as Miles pointed out. It does not mean that the purchasing power of the dollar has gone up. It's gone down significantly. You see it at the grocery store. You see it at the auto dealer. You see it in the housing market. We're in the middle of an everything bubble right now. That's inflation. And wait till you see CPI exceed 3% this year. That's going to be a wake-up call. And circling back around, that's what Platinum is telling us. Platinum is predicting a large, broad-based commodity price rally. Put your seatbelts on. It's coming here, and I don't think that it's 3 years. I think it's 6 months or less. And usually when that occurs, the white metals are going to outperform gold in that immediate cycle, especially when they're starting in an undervalued state, right? But gold in itself is due, in my opinion, for a 100% rally from wherever that bottom is that Miles is trying to predict. Wherever we get that correction and we get that bounce off that key support, that's when we're going to start to see things really roll over the next 24 months.
So that should about do it this week for Golden Rule Radio. As always, we appreciate you stopping by. If you liked what you heard, hit the subscribe button, ring the bell. If you'd like more information, you can find it at McIlvaney.com, on Twitter at ICA Gold, or Facebook at McIlvaney Financial. And as always, if you'd like to discuss your personal portfolio with one of the advisors at McIlvaney ICA, you can give us a call at 1-800-525-9556.
Thanks for listening. Have a great week.